Malaysia posted slower growth of 4.5% in the first quarter of the year. Now that's down from the fourth quarter of 2018. The slump is blamed on weak consumption and external demand, as well as global uncertainty caused by the China-US trade war. But the central bank governor says the economy is growing steadily nevertheless. The bank delivered further rate cuts this year, to the surprise of some analysts who did not expect that to happen until next year. HSBC Global Research says the Malaysian economy is holding up well by regional standards. However, it notes that investment activity contracted sharply in the first quarter and will likely drag down growth this year. Melissa Goh has more details on the country's economic outlook.
Well, Malaysia's Central Bank Governor Nur Syamsiah Muhammad Yunus, in unveiling the first quarter economic numbers, maintained that the country's economy is on a steady growth path, despite a weaker external demand due to protracted trade tensions between US and China. Now, Malaysia's economic growth slowed to 4.5% between January to March, hit by lower exports that contracted by some 0.7%. Now, Malaysia exports a lot of intermediary goods to China. Also, business sentiment has turned cautious. Public and private investments were both down. Still, Governor Nur Syamsiah is confident that the second half of the year will be better. Economic activities are expected to pick up following resumption of mega infrastructure projects like the East Coast Rail Link and Bandar Malaysia Development Project. Now, these have huge multiplier effects, generating jobs and so on. Now, also, Bank Negara has just cut interest rate to 3% to help stimulate consumption and support growth, given inflation is still subdued. But the central bank governor doesn't have a crystal ball. A lot depends on US-China trade talks and the geopolitical and global trade development.
Looking ahead, we expect Malaysia's GDP growth to remain within the range of 4.3% to 4.8%, driven by private sector spending, capacity expansion in key industries and gradual recovery in commodity sector. It is clear that downside risks remain in immediate horizon, stemming mainly from external factors. We will continue to monitor this risk and its implications on overall growth trajectory.
But economists I spoke with, they are more concerned about the possibility of Malaysia being removed from FTSE Russell's World Government Bonds Index. Now, already the Norwegian Sovereign Wealth Fund, remember, last month dropped Malaysia's government's bonds from its benchmark index, and this has triggered fund outflows of over 7 billion ringgit in April. Now, if FTSE Russell Index were to do the same and drop Malaysia, it will have severe implication on government bonds and on ringgit, as already the worst performing currency in the region. It fell more than 2% against the greenback in April. Now, in a bid to avoid all these, the central bank has announced a series of initiatives on Thursday to broaden and deepen Malaysia's financial market. Now, also to address concerns of foreign investors over the lack of hedging facilities on the ringgit and the lack of accessibility and liquidity in the onshore market. Melissa Goh, CNA, Kuala Lumpur.